been tasked this afternoon with merely explaining to you all why the blockchain is the financial challenge of our time. And like Catherine, I'm going to start with a little bit of history and an observation, actually, which is that I think one very good illustration of the sheer power of the technology that I'm going to be talking about, and Catherine spoke about, is the very significant difference of perspective that she and I bring to one subject, and yet both views are equally valid and I think additive. I want to start with some history. Given my 27, you shouldn't have given that away, Bob, 27-year track record in financial services, I obviously lived through the height of the financial crisis, and I know that in 2008, interconnectedness and opacity about that nearly brought the world's financial system to its knees. In the aftermath of it, there was significant reform of the global banking system and financial services sector. And some of that reform has obviously had a very significant positive effect. Obviously, the world's global banking sector is significantly less leveraged today than it was in 2007. On the other hand, some of the financial reforms have had some unintended consequences and are introducing new and different forms of risk that are equally important to understand. For example, central clearing of derivatives and central execution of the same have been mandated. There's a growth in the shadow banking system, in part because of the fact that rising capital requirements are forcing banks to reduce the amount of risk and the amount of balance sheet assets that they carry in their business. Market liquidity, as a consequence of that, and other things, has declined quite markedly, despite the fact that volumes continue to increase. Meanwhile, in this context of an increasingly centralized, regulated financial ecosystem, the rate of pace of transaction execution at the front end, if you will, of trading, continues to evolve almost to warp speed. Yet how ironic is it that the settlement of those transactions still lags by, in many cases, days, if not weeks? Some of you may be tweeting about what I'm speaking about, and someone in Sydney will probably have read about it by the time I sit down again. Those of you that just bought a stock on one of those iPhones won't be seeing it until at least next Friday. In this context of an increasingly electronified and high-speed financial system, operational resiliency has obviously become a significantly increased area of focus. Vulnerability to cyber attacks, operational failures, have become a major focus not only of financial firms, but of course of their regulators and other market participants. The biggest challenge faced by many of the major financial institutions in the world today is the fact that they are tasked with processing, recording, reporting to regulators and otherwise, reconciling and auditing ever-increasing amounts of sensitive transaction information. And yet the legacy infrastructure that we use to do that is generally pretty outdated. It is centralized. It is protected by perimeter security that has proven subject to repeated breach. The data contained therein is generally unencrypted, so once you get through that perimeter security, if you manage it, it's available for your interference and understanding. Generally speaking, there's a hub and spoke model involved, and enormous amounts of cost are involved in continuously reconciling the same data that's kept in different places at different times in different locations around the world for different users so that everybody can keep up with it all and on top of it, and then figure out why it isn't all the same at the same time. Those of you who work in financial services, I think, know exactly what it is I'm talking about. Those of you who look at financial services from the outside and imagine a world where you have innovated that sector out of existence, listen carefully to what I'm talking about. It's not necessarily as simple as it might sound. So in this context, I want to introduce why I believe that distributed ledger technology is a tremendously exciting and powerful development. In fact, it's the sheer power of that technology that forced me or attracted me to run a tiny startup but innovative technology company after almost 30 years in financial services at one of the biggest organizations on the planet. So what is the blockchain technology? You had a good introduction. Thank you, Catherine, for that. It's essentially an IT innovation that draws on cryptography, advances in the internet, and advances in computing power. Generally, these databases are based on open source internet protocol. So people who are doing the invention here are giving those inventions away to the world in the interest of seeing the world and its efficiency improve. Economic transactions on a digital ledger can be programmed to record virtually anything of value. Your identity, you heard that mentioned already. A will, a deed, a title, a license, intellectual property, an invention, but also almost any type of financial instrument. Not only are the facts of who owns what financial instruments or other items of value able to be kept efficiently in a digital ledger, distributed ledger, but also it's possible to record the actual business logic that has been agreed to between the parties in a financial transaction. This means the things that they have agreed to do for each other, their respective liabilities or responsibilities. So it's more than just the facts of ownership, the ability to convey a significant amount of nuanced and important information for the future management of those assets. And meanwhile, this ledger represents an incorruptible truth that can be accessed because of the fact of mass collaboration of different computers that are incentivized often by the creation of cryptocurrencies like Bitcoin to keep that information validated, verified, and stable. So this permits us to imagine a very changed financial system, infrastructure backing that system, where costs and risks and inefficiencies are drastically reduced and where transactions can be incorruptibly recorded in a cryptographically secure manner, shared by numerous parties, constantly reconciled and in sync by design, without the need for the cost of constant efforts to reconcile and to explain differences in that information. That is a hugely powerful concept for institutions that are dealing in financial information and transaction record keeping. And by the way, when we talk about the shared or public nature of distributed ledgers, that doesn't mean that all of the information is instantly being publicized. The ability to keep that private information as private as it needs to be is an important feature, of course, of encryption. So how can these systems tackle settlement latency in mainstream financial markets? Well, in short, because on a distributed ledger, in a token that is part of that ledger, you're able to embed the information that represents or evidences title to, for example, a financial instrument like an equity or a bond or even a loan. The list goes on. Once you've digitized in that way a financial asset, you can transfer its title on that distributed ledger in what is effectively real time, at digital speed. This then provides us with an immutable, uncorruptible history of transaction and asset ownership that can be accessed by multiple parties and is constantly, again, in sync by design. This means the entire life cycle of a trade, including its execution, the netting of multiple trades against each other, the reconciliation of who did what with whom and whether they agree, can occur at the trade entry level. That's much earlier in the stack of process than what you are accustomed to seeing in mainstream financial infrastructure. The total addressable market for these concepts is therefore measured in the trillions. Now, I don't want you to get too overly excited. Realize that the world is still a long way from a state where distributed digital ledgers have been able to be universally adopted. They are attracting a tremendous amount of interest and attention, essentially for the reasons that I just described to all of you. But there is a lot of work to be done, and there are many good and reasonable questions that need to be asked and answered about how we make this technology ready for mainstream adoption for volumes and values of financial assets that are measured in gigantic numbers. Can the consensus mechanisms survive concerted attacks? Can transaction capacity on the scale that we're talking about, literally thousands and thousands of transactions per second, actually be coped with in this context? Can privacy, which is important in this context, be appropriately maintained? Who is going to be processing and ensuring the validity of all these transactions? Can we know who they are? Can we do our know your vendor process on those transaction processes so that we can meet regulatory obligations? This is where my firm, Digital Asset, comes into the picture. Essentially, we're a company that is organized to help bridge the gap between the new emerging digital world and the existing world of mainstream financial infrastructure and architecture. Distributed ledger technology does have the potential to be disruptive of certain business models, but it has at least as much potential to be enormously empowering of existing business models in terms of making them lower cost, more efficient, and less risky. And at the end of the day, that will translate down into higher returns for the man on the street, ultimately the end investor who's investing his or her life savings. So it's not just important for the banks, the financial intermediaries, the exchanges, the infrastructure providers. It's important for everyone, just in a different way than in the context of consumer payments. Now, financial markets, as I mentioned, are regulated heavily, and they're regulated heavily for very good reason. Distributed ledgers have the ability to improve transparency for regulators and to allow existing financial firms to become less risky providers of valuable financial services. The vast majority of the operational costs of the existing financial infrastructure relates to tracking, reconciling, reporting, including to regulators, and auditing huge amounts of information. These functions are not going to go away. They have to be performed. The key is how do we enable them to be performed at higher speed and with greater efficiency. That is the potential of applying distributed ledger technology to mainstream financial markets. So we won't get there overnight, but we will get there. And firms are coalescing around this, including the major firms, as well as innovating firms like my own. We're helping the best companies in financial services understand how they can operate in the context of their existing operational infrastructure whilst exploring the opportunity to take advantage of distributed ledgers and do that at lower cost with greater efficiency. The challenge is to bridge that gap and to enable existing firms to leverage the technology in a way that's beneficial to them and their customers, as well as to their regulators. How seriously should you take this? I would take it about as seriously as you should have taken the concept of the internet in the early 1990s. It's a big deal. And it is going to change the way that our financial world operates. Finally, I'll close with just one comment, which is I spoke for quite a few minutes, and I didn't actually mention the topic of Bitcoin, or indeed any other cryptocurrency. The reason is that technology has the power to do many things, including to enable seamless payments between individuals on a peer-to-peer basis at much lower cost and less friction. But in fact, it has the capacity to do much, much more than just that. Thank you.
You know, one thing that's always amazed me is the transition you made. I'd like you to share something personal with us. You were one of the most powerful women on Wall Street. You worked for J.P. Morgan. Oh, I'm sorry. This is how careful you have to be. Right? No matter what, you give them a compliment and then smack. What do you mean, Bob? That's why you're not my old friend. Okay. Let's start over again. You're one of the most powerful women on Wall Street. And I'm curious about how you sort of made this transition. How did you decide to leave JP Morgan? Was there some epiphany when you looked at this business and said, oh my God, this is going to change the world? How did this happen?
Well, to be accurate, I left JP Morgan having sold the business that I ran for them. And so actually there was a natural break in my career, and I took the opportunity to try to take some time off. I was planning on taking a year, and I was minding my own business. I made a self-imposed rule that said no board work until you know what your day job's going to be, because there might be a conflict or something. And then I made an exception for this strange little distributed ledger-y, Bitcoin-y company that I joined the board of.
And how did that happen?
2 months later, I was running the company.
Something happened there, right? I mean, it's that moment that I'm interested in.
It was the penny dropping on the subject of the systemic implications of the technology. I had understood a little bit from a distance about cryptocurrencies and Bitcoin. I had not really, until sometime late last summer or the fall, when I took the time to start thinking about this, free from my day job, to really appreciate the power of the technology. And having come to this with the perspective of seeing what happened during the financial crisis and what changed afterwards, it gave me, I think, a slightly different perspective from a wholesale point of view than many others. I realized that we've improved a lot about the financial world since 2008, but we've centralized, we've created more and larger single points of failure. We have reduced risk-absorbing capacity on balance sheets, and therefore the benefits associated with being able to reduce the length of time for which things stay on balance sheet is increasingly powerful. And it was when I began to think about all of that in the context of blockchain technology that I decided I thought this was incredibly powerful and interesting.
Have the risks changed a bit since before 2008? I mean, to the financial system. Are there different kinds of risk now, and how can the blockchain help reduce those risks?
So the risks are different, and some of them are the same. So we obviously have lived through a period of low and relatively stable interest rates, and that will in due course come to an end. And we have yet to really test the behavior of the financial system during a major change of environment like that. And so there still obviously are major unknowns about how the financial system will perform under stress. The things that are new and are evolving are the increased speed, electronification of markets, the higher volumes, the more constrained balance sheets of intermediaries, the major broker-dealers and banks, and the fact that a significantly greater percentage of activity is being channeled by mandate through centralized points like clearinghouses in the derivatives markets.
Now, you mentioned obviously increased speed, but address the security issue, because that's something people still need to sort of get straight in their mind. Are you quite convinced, I'm not sure if this is the right question, of the unassailability of the blockchain? Is it secure enough to provide massive levels of financial transactions in a secure manner? Am I asking that right, or is that?
Yeah, no, that's a good question. So I would say that when you think about that topic, you need to think about what is the status quo today. How secure is our existing financial infrastructure? We're reading about it being under attack on a daily basis. And there are those who know that they've been penetrated, if you will, and there are others that do not yet know that. The blockchain was designed with the probability, or in fact the certainty of malicious actors in mind. And it has existed in the world, in the wild, if you will, in a native state without being compromised for what is a really long time in digital years, since it was invented around about the time of the financial crisis. The fact that it's also open source and subject, therefore, to continuous criticism and improvement is also a positive. Obviously, there needs to be thought given to stress testing, resiliency, ensuring that firms meet their regulatory requirements in the context of concerns about security, but recognize that one of the most powerful mitigants of risk of failure or risk of compromise is to diversify the consequences of that failure. If everything is kept in one place and it breaks because of a flood, an attack, any of the above, and you have to fall back to your second or third best choice, that is an inherently risky state of affairs. If instead you distribute the access to and storing of that information in multiple places where if one network point breaks, the others are there, much like the power of the internet is today, then you have diversified that risk significantly.
And the point being, if somebody breaks in and tries to manipulate a part of the blockchain to, say, create some other chain of ownership or something that wasn't there before, the others will be able to note that exists. I'm trying to get to the audience the point about the relative unassailability of the blockchain itself.
Oh, well, as it relates to the Bitcoin blockchain, there are different types of blockchain, different types of distributed ledger out there. But as it relates to that particular instance, the argument is that it's increasingly infeasible that someone would be able to essentially counterfeit a version of the blockchain in order to defraud users of it, because it requires an increasingly large percentage of the available computing resources in the world to do that. To say mathematically that it's impossible would be incorrect, factually incorrect. That it is increasingly infeasible is, I think, the best way to express that.
Let me move on. You didn't give us much detail on digital assets, the company you formed. I'm wonder if you could tell us a little bit about what you're doing with the company. What kind of services do you provide? I mean, walk us through what you're doing with this company.
So Digital Asset is a technology company that is seeking to bridge the gap, if you will, between the digital world, the ecosystem Catherine described, for example, and the mainstream financial asset world. If you think about the three layers of market infrastructure and digital infrastructure, there's a communication layer where transactions are initiated, signals are sent. There's a transaction layer, and there's a database or a protocol layer. We exist in that middle layer. We build business logic that enables users to essentially process transactions coming from the communication layer and report them or publish them to the digital protocol of choice. That enables secure settlement. It reduces counterparty risk, improves efficiency, and takes account of a few details, such as the existence of custodial systems in the real world today, which need to be taken account of and can't simply be imagined away overnight. The need to deal with cash and payments for assets in dollars, as in the kind of dollars that reside in a bank account. How do you pay for a digitized asset whose settlement you can speed up with a non-digital currency, such as dollars from your bank account, without taking significant operational risk, counterparty risk along the way? We provide the rails to do that, in short.
Yeah, secure settlement. It's a wonderful concept. Now, obviously, this applies to more than just transferring money around. Are you also quite convinced of the value of the blockchain in, for example, real estate transactions, stock settlement? Can you see this being used in the near future? It seems to me a very obvious applications, which is why I'm so excited about the blockchain in general.
Yeah.
Even though cryptocurrencies is what we're talking about, but the blockchain application seems vast to me.
Yeah. I was just talking this morning to a friend back home in England who works for the NHS, the National Health Service, which is a publicly provided service in the UK, where identity management and access to those services are obviously important to be able to manage efficiently. Not to mention the idea that you should be able to show up, identify who you are using some kind of biometric identifier like your fingerprint, and have your medical records available wherever you are in that central point of the healthcare system, in that local point of the healthcare system that you're in. That's just one of the numerous examples that you can bring to mind as you think about the power of distributed ledger technology. Where my company is focusing is in our area of domain expertise, which obviously is financial assets, including securities, loans, bonds, private stock, and so on. And we're particularly focused on the settlement latency and the risks and the transaction processing costs in that world. Why? Because that's our area of expertise and because those are very big markets that have today very large inefficiencies. But you're absolutely right that this is just one narrow area of the many areas in which this technology will be deployed over the years to come.
So how do your old colleagues feel about this? You're still in touch with all of your friends on Wall Street. You go and explain this to them, and what do they...
They still hate me.
What I can't understand that. What's the... Why do you... Do you go and tell them that it's not disruptive, it's constructive?
I've used that phrase.
I know.
And the answer is they totally understand that. It's not just my old colleagues, but the major financial firms, both banks, broker-dealers, and the exchanges and infrastructure providers have all begun to dedicate a significant amount of their time and effort to understanding and experimenting in and around this space.
But do they get it? Do they I mean this disruptive versus constructive a little bit tongue-in-cheek. Do they understand that this could be a technology, if they adopted it, that could make their business a lot safer and quicker? It could also disrupt the amount of money they make, for example, rather dramatically. I guess I'm trying to figure out, do they see it as a threat? Do they trying to figure out how to manage it? Do they want to adopt it, but they realize it could hurt profitabilities to some extent? How is it being looked at?
Well, let's take a look back at what the internet was in people's imaginations in the early or mid 1990s. Everybody knew it was kind of a big thing. Nobody knew exactly what direction it would go in. What would happen to the people that had bricks and mortar. Would people ever do banking online? Would that be a threat to banks or not? The answer is, obviously, with the benefit of history, that the internet became an unbelievably powerful tool for many different business applications and is used accordingly today. And there have been winners and losers, those that embrace and learn to use that technology to drive customer service, drive down costs, improve customer experience, have won. And those that didn't manage that or got left behind or didn't realize have lost. It's not just about technology. Obviously, there are other factors, but that is essentially the same or the analogous situation here today. Those that learn enough to be able to take this technology and meld it to achieve their commercial business purposes will both be able to gain competitive advantage and or be able to ward off competition. And at the end of the day, they're doing that by reducing costs, improving efficiency, doing a better job for customers. So that's not a bad thing. It's a good thing.
So you couch it in the terms of improving simple customer service in a way, giving people what they want, moving money faster and more securely. It's what the customer wants.
For example, yeah.
Yeah. Before I let you go, Reid Hoffman wrote a very interesting story in the current issue of Wired UK. At least one global cryptocurrency will achieve mass market adoption. Not a huge prediction, but we will see the emergence of Bitcoin Googles, Bitcoin Facebooks, Bitcoin Alibabas very soon, massively valuable companies for which no contemporary analogs exist, not even on the internet, built on the platform's foundation of decentralized trust and programmable money. Do you think that this is that massively disruptive on an internet level almost? He talked about Bitcoin Googles, Bitcoin Facebooks, Bitcoin Alibabas.
Yes. I would say blockchain rather than just Bitcoin, but yes, distributed ledger, yes. I
agree, and we're going to hear a lot more about this in the next few minutes. Blythe Masters, thanks so much for joining us. Good luck on the next lecture. Appreciate it. Wonderful job.